to hear my conversation with Laurent Bukabza. Today, we're digging into where investors can find income, how to diversify globally, and staying agile with next gen ETF strategies, especially in a market shaped by higher rates, rising volatility, and a changing world order. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, a podcast from Mackenzie Investments. I'm your host, Prerna Matthews, Vice President of ETF Product Strategy. In today's episode, we're joined by Laurent Bukabza, ETF strategist at Mackenzie Investments, to explore how innovative ETFs like covered call dividend strategies and active international equity ETF exposures are helping investors balance trade offs between growth and risk in today's evolving market. Laurent, thank you for joining the podcast today.
Hi, Perna. Thanks for having me on. Great to be back.
Wonderful. Let's dive in with the topic of income and income through covered calls and leveraged covered call ETFs. So, to start off, can you walk us through how covered call strategies work and how and why they're gaining traction now?
Yeah, sure. It's definitely a hot topic these days. So if you look at corporate call and dividend-focused strategies, there's been a lot of assets that have been going to this market in the past few years. So, Canadian, US high dividend category at the end of May, get a few stats. We counted about 3.5 billion net flows over 1 year and total assets of 27.8 billion, so almost 28 billion. In the cover call category, there is more than 50 different ETFs available with underlying assets, going from equities to everything like US bonds, for example, cross strategy on bonds. And we are seeing 3.5 billion net flows over the past year and total assets of close to 26 billion. So they've been attracted definitely, as you mentioned, a lot of assets. And one of the main reason is the perspective for investors to get increased yield in the portfolio. So this is particularly true in the context of lower rates, and the rates have been going down. So they're not at near zero level like they were before COVID or at COVID, but still they're pretty low. And you have an aging population where income needs and income generation are front and center in financial planning for clients. And so, how do they work? I don't want to get too specific and too technical here, but the simplest way to understand a covered call strategy is to break it down. So the ETF, first of all, will hold a basket of stocks, or as I was mentioning, more rarely bonds, for example, and the ETF will sell call options on some or all of the stocks that are underlying in the portfolio to collect the options premium. And so the premium is distributed to investors, and that's boosting the yield from the underlying portfolio. So, obviously that's the basic, and it can get a lot more complicated than that. But the thinking behind corporate call strategies is to generate extra income by selling option in the portfolio and collecting option premiums.
Yeah, it's great. So, you're highlighting a key point here that yield doesn't just have to come from fixed income. And we've seen a lot more investors look to the equity portion of their portfolio and how that's generating them a yield as well. So, appreciate the simple breakdown of how these portfolios or strategies are typically constructed. Now, we've also seen the growth of leveraged cover call strategies. So, can you walk us through the key difference between traditional covered call ETF, which you just sort of broke down in very simple terms, and what a leveraged covered call strategy offers?
Yeah, sure. So the thing is, corporate call strategy has one big pitfall, and it's the potential upside loss that comes with it. Because when you sell a call, you basically sell the right to the call buyer to buy the stocks from you at a predetermined price. And the issue is that if the stock hasn't performed your predictions, you will have to sell the stock at a predetermined price that might be or that will be lower than the current market price. So you receive the option premium, but you're not capturing part of the upside. By introducing a bit of leverage in the portfolio, what you allow is for increased exposure to the underlying stocks. So you conserve the full exposure to the underlying portfolio, and by doing so, you are mitigating a little bit the impact of the upside loss potential if the options are exercised and the fund ends up being forced seller of these stocks. So you keep the full exposure to the portfolio. That's how leverage helps.
You raise a good point in that there is no free lunch, right? There's always a trade off, and you've highlighted some of those. So, how should investors think about that if they're looking at these products for yield pickup? But as you've noted, there is this performance give up, particularly in the long term if you're holding these types of strategies. So, how can investors think about that trade off?
Yeah, that's the main question when it comes to covered call strategies, finding the right balance between increased yield and upside capture. So I think, when we have conversations with clients, the first thing that people should consider is the sustainability of the income. If the yield they're receiving is sustainable, does it seem reasonable, and what that entails. We've seen some ETFs posting very, very high distribution yield paid out to investors, but the issue is the underlying portfolio and the option premiums combined do not generate that much yield. So part of the distribution could be return of capital. So it's important to look at the total return of the strategy and not just the posted yield, because it can be misleading and it can be unfunded. And so what's happening is you're going to grind the NAV to pay out these big distributions that you are not generating, or you're completely losing the upside potential. So there is many things that will have an impact, such as the option strategy, how it's implemented, whether it's systematic or it's actively managed, the proportion of the portfolio that options are being written on, and how far the money. And as a general rule, I would say the further out of the money, obviously, the lower the options premium. So and the closer to the money, well, the bigger, the less upside potential you get. So comes down to, I would say, due diligence really, and questioning how reasonable and achievable the advertised yield is. And that, remember that not all covered call strategies and ETFs are managed or created equal.
Yeah, good points and great some really great actionable takeaways for our listeners. One last question on this particular topic before we move on, but are there particular environments that these strategies, covered call or leverage covered call ETFs tend to do best in?
Yeah. Um, I think, it's important to, first of all, take a step back and consider what is performance. What is the right measure of success for these ETFs? And, we just discussed that increased yield can come at the expense of upside. So a good measure of performance for a covered call strategy is total return of the investment. In other words, you look at how the covered call strategy outperformed, and if it outperformed the same portfolio without call writing. So thinking about performance drivers, again, you get income from the yield premiums and you get upside from the underlying stocks. And you will find that cover call strategy tend to add most value in sideways or slightly down markets, flat market, as the calls do not get exercised. So and you don't lose any of the upside because there was no upside. So it's relative performance. And for generating income, volatile periods can also help outperform, as the options premium you receive will tend to increase with the volatility. So when you calculate the option premium and you're selling this option, the more volatile the market, the higher the premium is. So you generate more income as a call seller. Uh, and here again, we just talked about it, but modest leverage can be beneficial too for outperforming the similar strategy without cover call.
Great, very helpful insights. So let's pivot a little bit now, talk about the second topic for today, and that is around international diversification. In light of all of the trade and tariff commentary activity and action happening globally, we've seen a lot more demand for international ETFs. Tell us more about that shift. Tell us what that's looked like so far this year.
Yeah, it's a pretty interesting year, and it's all really driven by the uncertainty in U.S. politics and policies. So the market had some pretty strong reactions. For example, we've seen the biggest spike, the two biggest spike in the VIX since COVID in just the last few months. And this has driven, some rethinking around asset allocation in the portfolio. So asset allocators all around the globe are expressing a bit more discomfort, I would say, with high US concentration in a very volatile context. And you don't know what's coming out of the White House and how that's going to impact the market. So at the beginning of the year, for example, if you look at the US represented 72% weighting in the MSCI world. It's the highest on record, and again, obviously highly concentrated in a few stocks. So looking at the other investable universe, developed markets with valuation that seemed more attractive, has sparked a lot of conversation, asset allocation, and revision really of portfolio to diversify out of the US into international equities.
Yeah, great points. Now, not all international equity ETFs, I'm sure, are built the same. So, can you talk to us about that? Passive to active. How do different types of international equity ETFs aim to capture that opportunity while managing risk and in that fragmented global economy that you spoke of?
Yes, that's a really good question, Perna. And as a listener of your podcast, I've noticed that you recently talked about the importance for Canadian investors to be buying Canadian listed ETFs, buying directly the underlying securities, and international equity ETFs are really at the forefront of that. So you want to be mindful as a Canadian investor not to have the money transit through the US whenever you're buying international equity exposure. So whether it's a US listed ETF or a Canadian listed ETF that's wrapping a US listed ETF, this would lead to foreign withholding taxes out of the US. And so probably not the best option for our Canadian listeners. Also, as you know, the active part of the active management part of the ETF market is the fastest growing part of the market. So international equity are also a big part of it. So we've seen obviously index ETFs that are replicating international equity indices, but we've also seen active quant approach, for example, at McKinsey, allowing us to process huge amount of data, looking at thousands of data points and collecting as much insights and info as possible to forecast future behavior. So, in our case, looking at three super factors, 25 sub factors, and creating a portfolio of stocks that are most likely to outperform, and staying within sector and geography bands to make sure we don't stray too far away from the index, leading to um, loss of upside again. So this has led to similar standard deviation, and this is a really important measure that we look at. You just want to make sure that you're not capturing excess return at the expense of too much risk, too much added risk in the portfolio. So we work under risk constraint always, and the goal is to beat the index on every time period. And I want to insist on that point a little bit because consistency, if you've read literature, it's the hardest thing to achieve for portfolio managers that are trying to beat benchmark. And our GQE Global Quant Equity team has been doing it on every time period in our active equity ETFs, but also across 25 mandates for more than 30 years now.
Those are great takeaways. Perhaps we can now talk about the asset allocation piece and how can advisors, investors think about incorporating international equity into the portfolio as part of their global exposure? How and where do these products fit? How should our listeners think about asset allocation with international equity?
It really comes back to diversification and diversification benefits and the exposure you want the portfolio to exhibit. So, as I was mentioning, if you are integrating a world index in the portfolio or world exposure, thinking you're diversifying away from concentration in US stocks, you're just piling on it. So, simply using global mandates to diversify away from US concentration is not achieving the desired goal, and advisors may need now to dig a little bit deeper than before to ensure they're using the right tools to get the benefits of diversification they want to achieve. And once you get the tools, once you've done your due diligence and you're sure of the exposure you're getting, and then I would say, secondly, you want to find the ones that are performing the best while respecting the client's risk tolerance. So that would be kind of the easy two-step process to make sure that your portfolio is well diversified. And year to date, if you look at the returns of the US equity market versus international equity market, this would have been a very fruitful strategy in the portfolio.
Yeah, great. Um, Perfect. Now, in our remaining time together today, Laura, I'm hoping we can spend a little bit of time on another key concept that impacts all ETF investors alike, no matter the exposure in the portfolio, and that is around trading and liquidity. Of course, the way you transact with ETFs is on exchange, and so let's spend a few minutes on that topic, and we can reference international equity and covered call strategies as well. But there's still a lot of misconceptions about ETF liquidity. What's one thing that you wish more investors, advisors understood, and anything specific as well to international equity ETFs or ETFs like covered call strategies?
At the risk of sounding like a broken record, but we'll never repeat enough that the liquidity of an ETF it's not its volume nor its AUM, but really the liquidity of the underlying securities. Um, so I would say in the case of international equities or next gen ETFs, the ability of the ETF provider and the management team to efficiently integrate flows and stay true to their approach is something that can play a role as well. You want to make sure that there's not going to be huge spikes in tracking or tracking difference or the strategy not being implemented properly because the ETF issuer is not able to accommodate for larger inflows, right? So when looking at non-index ETFs, this is an extra consideration. But again, volume and AUM do not represent the ETF liquidity. It's really the underlying securities. And in the case of non-index ETF, you want to add the extra layer of deploying cash efficiently.
Okay, great reminders. But what should advisors keep in mind when executing trades in ETFs with lower AUM or newer strategies? I mean, we continue to see new products launch every month, every year in the Canadian ETF industry, including from Mackenzie Investments. But what are your recommendations, tips on how advisors best execute in those newer ETFs with lower AUM?
Yeah, it's important to remember that every ETF had low AUM at some point and built its asset base from there, right? So a low AUM in itself is not something concerning, really, especially for newer strategies. We've seen numerous examples of newer ETFs getting massive trades, block allocation and the AUM of the fund being doubled or tripled in one single trade without impacting the ETF price. Trade going toward the offer or sometimes even below, you see some price improvements. Trade going overnight at NAV. There's extra layers of liquidity, obviously, in the ETF. So I would say that advisors have an entire ecosystem around them, whether it's retail trading desk, market makers, capital market specialists, dedicated support readily available from ETF issuers like Mackenzie. So I would say, you know, all of that exists and it's there for a reason and it's actually free in a certain way. So you're not paying more whenever you're buying an ETF if you use all the support that is at your disposal. So I would say advisors should really use the resource, call the rep, the trading desk, and make sure we're supporting the trades, providing guidance, and at the end of the day, it's really best practices and ultimately ensuring best execution on trades for the end clients.
Wonderful. Laurent, thank you for sharing your insights today. Your perspective, especially from working closely with advisors across the country, has really brought these topics to life today. So thank you.
Thanks for having me again.
Well, we covered a lot from how covered call ETFs can help generate consistent income and navigate market volatility to why international diversification is becoming a core part of modern portfolio construction. The key takeaway in today's complex environment, it's not just about chasing returns, it's about building smarter, more resilient portfolios using the right tools. That brings us to the end of this episode of The Invested. Thank you to our listeners for tuning in. We hope this episode has provided you valuable insights on how ETFs can be used in your portfolio construction. If you have any questions or topics you'd like us to cover in future episodes, please reach out via our blog or through LinkedIn. Until next time, stay invested.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income tax payable by any security holder that would have reduced returns.